Hi guys. As we look out over the long river of history, we see China transforming from a follower into the core engine of global manufacturing and the world's second-largest economy. Many authoritative institutions predict that China's total GDP may surpass that of the United States within the next decade, becoming the world's largest economy. Against this grand backdrop, what kinds of investment opportunities and risks do Chinese concept stocks truly represent? Let's take a look together. China's economic rise is no coincidence. Today, China produces nearly 30% of the world's manufactured goods, from smartphones to electric vehicles, from medical equipment to aerospace technology. The label, Made in China, can be found in every corner of the world. As representatives of this economic miracle, leading Chinese concept stocks such as Alibaba, JD.com, and Pinduoduo are not only models of commercial success, but also reflections of China's supply chain integration capabilities and its innovation in the digital economy. What's especially worth noting is that as China shifts from being the world's factory to the world's innovation hub, a new wave of globally competitive tech companies is emerging. These companies not only serve China's massive domestic market of 1.4 billion people, but are also expanding into Southeast Asia, Europe, and Latin America, building truly global operations. This growth story, rooted in the strength of the real economy, provides a solid foundation of value for high-quality Chinese concept stocks. However, we must clearly recognize that the shift in China-US relations, from cooperation to competition, and even confrontation, has profoundly reshaped the investment landscape. This is not only a trade war or a tariff war, but also a systemic contest involving technology, finance, and even global governance models. The tariff war has taken the lead. The average U.S. tariff on Chinese goods has surged from 3% in 2017 to around 19% today, directly squeezing the profit margins of many export-oriented Chinese companies. Even more far-reaching is the technological blockade. Export controls targeting critical areas such as semiconductors, artificial intelligence, and quantum computing have placed severe pressure on the supply chains and R&D capabilities of certain Chinese tech companies listed overseas. At the capital market level, regulatory pressure continues to intensify. The implementation of the Holding Foreign Companies Accountable Act, HFCAA, has turned the dispute over audit papers into a Damocles sword hanging over Chinese concept stocks. More than 20 Chinese companies have already been forced to delist from the U.S. and seek secondary listings in Hong Kong or mainland China. This forced relocation not only increases compliance costs for companies, but also affects investors' expectations regarding liquidity. And then there is geopolitical risk. As China-US competition enters deeper waters, economic issues inevitably become politicized. Whether it's data security reviews, restrictions on investment in critical infrastructure, or the threat of financial sanctions, any of these could change the rules of the game overnight. The swift sanctions imposed after the Russia-Ukraine conflict have served as a stark warning to all multinational companies. We must also pay attention to market sentiment risk. Chinese concept stocks often become the scapegoat during periods of geopolitical tension, resulting in price volatility far exceeding changes in fundamentals. Data shows that during the outbreak of the Russia-Ukraine conflict in 2022, the Nasdaq Golden Dragon China Index recorded a single-week decline of 22%, while the S&P 500 fell only 8% over the same period. Such sentiment-driven sell-offs often lead to high-quality assets being unfairly punished. In such a complex environment, Chinese concept stocks are experiencing unprecedented divergence. Companies that rely excessively on a single market, have opaque governance structures, or lack control over core technologies will find it difficult to weather economic cycles. In contrast, companies with a global vision, strong technological autonomy, and diversified revenue streams are more likely to grow and thrive amid these challenges. Take the new energy vehicle, NEV, sector as an example. Some leading Chinese companies have already built global networks covering R&D, manufacturing, and sales, with battery technologies reaching world-leading standards and Europe accounting for over 30% of their total sales. These companies not only avoid the risks of relying on a single market, but also earn valuation premiums through their globalized operations. Conversely, companies whose business is highly concentrated in the Chinese market, that rely on regulatory arbitrage or simply replicate business models, are facing investor backlash. Over the past 3 years, the overall PE ratio of Chinese concept stocks has dropped from 35 to 18, but the divergence is striking. The top 30 companies maintain valuations of 25-30 times earnings, while most others trade below 15. The market is voting with real money, rewarding truly global enterprises and punishing those with only superficial international footprints. As stock market investors, we must first assess a company's irreplaceability, whether it has true technological moats or a business model that cannot be easily replicated. Second, we must evaluate its geographical diversification, whether its revenue, assets, and teams are truly global. Third, we should examine its governance transparency, whether its financial reporting and decision-making processes meet international standards. In terms of portfolio allocation, the old wisdom of not putting all your eggs in one basket is especially important. Professional investment institutions generally suggest that Chinese concept stocks should not exceed 20% of one's emerging market exposure, and preference should be given to companies listed in both Hong Kong and the US, with core assets located overseas. Hedging strategies should also not be overlooked. Tools such as options and cross-market correlation trades can help mitigate unpredictable black swan events. Looking ahead to 2026 and beyond, the fate of Chinese concept stocks will be closely tied to China's broader economic transformation and the trajectory of international relations. If China continues to advance high-quality economic development, overcome core technological bottlenecks, and resolve audit and regulatory issues within the framework of international rules, high-quality Chinese concept stocks may regain global investor confidence and see valuations return to reasonable levels. But this journey will not be smooth. The long-term nature of great power competition, the restructuring of the global economic landscape, and the race over technological standards all mean that Chinese concept stocks will continue to navigate stormy waters. Investing in such assets requires more caution, more professional analytical tools, and a longer-term perspective than ever before. Amid the complex and shifting dynamics of great power rivalry, investing in Chinese concept stocks requires both wisdom and courage. We should not be blinded by ideology and overlook their growth potential, nor should we ignore the regulatory risks unique to these companies simply because we believe in China's long-term rise. Rational investors must recognize China's upward trajectory while acknowledging geopolitical realities and seek companies with true global competitiveness. China's economic rise is one of the most significant trends of the 21st century. As the capital market reflection of this trend, Chinese concept stocks, despite setbacks, will eventually find their rightful place in global asset allocation. The key is to approach investment with professionalism, clear thinking, and a long-term perspective, carefully selecting individual stocks to achieve desirable returns.